straight off. When you have a special guest on the show, you want to start the show with that special guest. And it's always a pleasure, if I may add, a rare pleasure to have Ridham Desai, Head of India Equity Research and Equity Strategist with Morgan Stanley, joining us. And when he's joining us from the sidelines of the Morgan Stanley annual conference, well, you should get your pen, paper, sheets and phone ready, because he will be sharing a lot of insights, as always, especially at this investor conference. Ridham Bhai is always in a mood to share more. So we are looking for that more in this conversation today. Good morning. So nice to have you back on ET Now.
Thank you, Nikunj. That was, I like the word rare.
Well, the India story is not a rare story. It's, I think, the most consensus story in the world. Macros are strong, valuations are reasonable, growth is decent, and other macro parameters are stable. Is that the positioning which India has enjoyed? Do you think we will continue to enjoy for a long period of time?
Nikunj, actually I disagree with you. India is not a consensus story. It's a consensus story. It's far from that, actually, because if you look at foreign portfolio positioning, they are the most underweight on India they have ever been in history. So clearly they have not understood that India's macro stability, its growth, kind of justify the valuations at which equities trade at. So they look at the headline PE multiple and they think, oh my God, this is very expensive. But it is not. I don't think Indian equities are rich. Actually, I think they are very reasonably priced. We just actually wrote a note yesterday which is titled as Equities Appear Cheap. And it requires a little bit of exploration, a little bit of digging. You cannot just look at the headline PE multiples and this is expensive. India's beta has fallen. India's growth has become more predictable. And all these things contribute to the PE ratio. But if you do a little bit more intrinsic valuation, stocks are cheap. And this is not something that people outside India have completely understood, which is why they are underweight.
Set the tone that India is the best story, but globally it is not a consensus trade in terms of investment. But we'll interweave our today's interaction on the mega trends, macros, valuations, and where you are finding money-making opportunities. So let's first start with the macro setup. Is this the best you've seen in a long time? Inflation is coming under control, crude is behaving itself. On the tariff front, things are looking okay now, and GDP data also seems to be encouraging. Is this the best macro setup we are in a long time?
I wouldn't characterize it that way. I would say that this has been the setup for many months now, give or take a few months here and there. We always go through a little bit of cycle stuff, but we've been in this situation where we've had reasonable growth with low inflation, but more critically with low inflation volatility. Interest rate volatility has been low. So that's been the setup for India for a while now, and it's been driving earnings growth. We did go through a soft patch last year. I think we've easily come out of that. We came out of that soft patch a few months ago. But the global macro is actually more challenging than it has been for India in a long time. China is facing deflation pressures and will export its deflation to the rest of the world, and that may bring some problem for Indian exporters. The US is going through its tariff stuff, which is, I think, definitely hurting US growth. Our US growth forecasts suggest that US growth will be half of what it was last year. So that's a tough global macro environment. More structurally speaking, the world is heavily indebted more than ever before, and it is aging, and that's not a very good complex to have. So I think India is in this, is what I term as the oasis in a desert. It's a tough global environment, and in that India shines like a bright star in a dark night. So I think that's how I would characterize this, and I think the global story has only worsened at the margin, and India's story has, at worst remained steady, at best has continued to improve.
Can I conclude from your answer that it's a matter of time. The flows which have come back into India in the month of May, that will only accelerate, and you see the sands shifting, at least for global allocators, back to India from at least US?
They wish to, Nikunj, and they will want to. But the problem here is that domestic investors are persistent buyers of Indian stocks. There was a lot of skepticism when the small cap, mid cap correction happened that retail will run away from the market. Well, retail investors in India have an average holding period of over 35 months, 3 years. They are far more long-term oriented than all the institutional investors in the world. And they are not getting scared by a 10-20% correction. So unless somebody starts selling in the domestic market, how are foreigners going to buy? They can only buy if somebody sells. There are two cohorts that can sell. Either domestic sell or corporates start issuing paper. I suspect as we go into the second half and beyond that, and there is some stability in US policy, corporate issuances will pick up. And that will give an opportunity for foreign investors to continue to engage in Indian stock markets.
It is the net flows which come into India. Second is, so supply is going to be, demand is going to be strong. But what about the supply side, which is, since you mentioned that new issuances, IPO, promoter block, could that be the impediment going forward? While the gross numbers will be strong, it is just that new paper, in a sense, will have an impact in terms of what the existing stocks would do.
No, we are actually very far away from that moment, Nikunj. You know, in the 2007-8 cycle, issuances rose to 3% of GDP before the market got affected. That number means corporate issuances have to go at a run rate of about $10 billion a month. And that has to continue for 7, 8, 9 months on the trot for it to actually cause damage to share prices. We are a little bit far away from that cycle. That happens when there's a full-blown private capex cycle and valuations are much richer than where they are today. Neither of those conditions are satisfied. So I don't expect those issuances to happen, those type or level of issuances to happen over the foreseeable future. I think it's a little bit far away. So we're okay. I think if you look at the net number, it should still favor the market. So the bid will, I think, outstrip the supply or the offer.
Exactly 60 days ago, just about every conversation was centered around tariff. And it didn't stop at 2 times the tariff. Third time also everyone said tariff. What is your understanding of tariff, if they are at play, and how will that change the dynamics for India and for US?
So I think India in particular is not so affected by this. Our trade with the US is all of 2% of our GDP. It's a relatively small number, and I think we are in fairly advanced stages on the tariff deal with the US, and probably this month we should see the first portion of that deal. I think the impact is more on what happens to other countries and how that may affect global trade if the tariff levels go back or come closer to where we were at the start of this 60-day cycle. If we end up where we are today, then I think that's probably getting baked into both share prices as well as the economy. The numbers on global economy, particularly the US, will actually worsen from here because the effect of the tariff comes with a bit of lag. But if things worsen from here, and if there are reversals on those and deals don't happen because there's a 90-day window, so that expires in 30 days from now. If that doesn't happen, then I think we may be in for another bout of extreme volatility like we saw in April.
Ridham,
Nikunj, if I may just add here,
yes, please.
While everybody focuses on US tariffs, there is another very important thing that is happening, which is immigration. Last year, US immigration was almost 3 million people. that number is likely to slow down considerably this year. Now, incoming people into the US workforce were acting both as a cap to wage growth as well as were adding to the consumption demand in America. So it was almost the secret sauce of what US growth we experienced post-COVID. And that may unwind as well. So it's not just the tariff thing, but also what goes through with immigration. We're expecting immigration to drop considerably in 2025 and then again in 2026. And it will act as a drag to US growth, may actually bring wage inflation back into the fore, and may create supply side challenges for America. So this is the reason why the Morgan Stanley view is that US growth slows down perceptibly this year and next year, but the Fed will be reluctant to act because inflation will be quite elevated. And that is the template that we're dealing with. It's not a very happy template for stock markets. India, of course, is, I think, going to behave idiosyncratically and very differently and will likely outperform a global environment like this.
Ridham, last time when we interacted with you, distinctly pointed out that the store of value in the market is large cap. Within that, if you're really looking at treasure hunting, well, banks, they really fit the criteria. Banks have done rather well for themselves, and large cap stocks have also picked up some weight in last 6 months. Would you still call large cap stocks a store of value, or that trade is over?
So see, Nikunj, what we have seen is that the correlations of returns across stocks with the market have gone up considerably in the past few months, which essentially means, in simple words, that the overwhelming factor that has been driving short-term returns is the macro. Now, this is a mean reverting variable. These correlations tend to make a peak and then start declining. We are at that point, I think, in the market cycle. So we're actually transitioning into a stock picker's market. Macro will wield less influence, and idiosyncratic company-related and stock-related factors will become the key driver to share prices. In such an environment, it is okay to be sector and capitalization agnostic. So I think at the moment, my instinct is to actually just look at companies bottom up, rather than look at any particular cohort that mid-cap, small-cap is doing better than large-cap. I think there are good stocks across all these capitalization cohorts, and that's the way to approach this. And in fact, the same for sectors, which is why we have shrunk our sector positions considerably over the past month, and we are virtually hugging the benchmark because this is not an environment where it really merits focusing on a couple of sectors and making outsized bets on them.
Of how the markets would move in next 12 months, what will influence that script? Will it be global flows coming back to India? Could it be surprise on the local front, which is earnings and inflation? What will influence the script for India for next 12 months, Indian markets for next 12 months?
So I think earnings will do a whole lot better than where the consensus is right now. We have come to the end of that massive fiscal compression that we experienced last year. But critically, the RBI has lifted the foot off the pedal. So it's in dovish mode, which should help credit growth and growth overall and earnings growth. I expect the government to continue pursuing reforms. I won't be surprised if at some stage there is a major GST rationalization, which will be another growth kicker for India. At home, I think we should see some signs of improving capital spending by the private sector. And that, I think, is also going to be constructive for growth. Globally, I would imagine that there are risks on both sides, which is the upside risk is that the tariff war is over and things actually turn more benign in the second half. The downside risk is that it's not over and we go back to the April template. And this is very hard to call, but it's something that India will have to deal with. I think India will be less volatile than the rest of the world. But if it happens, then there will be some volatility. But the biggest overhang, I think, is China. China is seemingly entrenched in deflation, has a lot of excess capacity and it will throw that stuff around in the world. It will compete with exporters elsewhere, including Indian exporters, and that may, I think, be the the surprise downside risk to both global equities as well as Indian equities.
So I'll increase the timeline by 12 months to 36 months, and something which you really are qualified and you've been answering over the years to your clients and to our, you've been identifying it for our viewers. 3 years out, if somebody is really betting on earnings surprise, P re-rating and massive mega trend, what would that be?
I think industrials will probably look very good because we'll be in a very strong capital spending cycle in that time frame. So industrials should be looking good, followed by the lenders, because any capex cycle will also involve balance sheet expansion. Corporate balance sheets in India are very light. Corporate debt to GDP is at 50%, and it is going to likely materially expand from here. So I think the lenders and industrials, those that are supplying to India's capital spending demand, are the two places which should be watched out for.
You see a comeback in consumer staples and discretionary. Staples are expensive and discretionary spend in a sense has been under pressure. Can they make a comeback largely because of inflation, earnings growth, the wealth effect and also the tax cut?
On a 12-month time frame, that's my favorite sector, discretionary consumption. Not so much staples. I think staples has got more problems than just valuations. I think competitive landscapes have intensified, and therefore the growth for the listed companies will not be so easy to come. The moats for listed discretionary companies seem a lot stronger. Rural consumption is already doing well, and I don't think there should be any surprise if urban consumption recovers in the second half. So on a 12-month basis, I think consumer discretionary stands out as a sector to back. In fact, I may just add that if I look at the list of investor meetings at our summit, the top demand is to meet consumer discretionary companies, and that hasn't happened in a while. So I can clearly see investors are also warming up to the likelihood that consumer discretionary stocks do very well in the next 12 to 18 months.
Ridham, if I could encourage you to narrow down consumer discretionary to something specific. I mean, it starts with autos and goes all the way to white goods and brown goods. What is your definition of consumer discretionary?
So I think autos and auto ancillaries, and then I think retail. If I were to pick up two, I think transport and that is travel and leisure will probably continue to be bright spots, but they have been doing very well already. So there's no delta there, but they'll continue to do well. So maybe these three sectors are what we should look at sub-segments.
The YouTube videos, I mean, I do get threatened when you interview somebody like that as a television anchor. But when I look at those television YouTube videos, the real center theme of some of those videos is digitization of India, productivity, efficiency gain. How would you see this entire digital engine now shaping up things? Because 3-5 years, what looks small will become big, and what is big right now could become mega. How do you see this entire digital wheel changing Indian companies, sectors, themes, and ideas?
The digital theme has been underway for a while, and a lot of companies have launched businesses around that and have already gained significantly. I think the biggest delta probably comes in the financial sector from here on. And if you look at what Nandan Nilekani is saying, I think the account aggregator concept is taking off. The second thing I think is in electricity, because again Nandan is very eloquently explaining how the next stack on India stack will be around electricity, which is not only that you'll be buying, but you'll also be selling electricity. So almost every individual in this country may become a trader in electricity. So that's a very nascent concept. I think on a 3 to 5 year basis, it may actually become very interesting. So we'll keep a watch on that. But the immediate gains, I think, will probably take place in the financial sector.
Specifically on power, Ridham, it is now become the go-to space, whether it is solar, whether it is renewable, even power utility stocks, they've done rather well for themselves post-COVID. What is the best way to look at power as a sector, and within power, what stands out for you?
I think the supply side, which is the supply chain that will build India's transmission, distribution and generation capacity, is probably the place you want to be. So that's, I think, very exciting. India needs to invest massive amounts of money in this place if it wants to secure its growth. And just as a side point, likewise in defense. So I know some of these stocks are very rich and you get opportunities. They sold off very heavily in the first quarter this year, and that gets you that opportunity. And whenever such opportunities come about, I think these are the two sectors where fundamentally India needs to have a multi-year investment cycle.
Shamelessly extend my appointment with you. I know somebody's beeping
Sorry.
you, but can I? It's gone? No, he's there. He's there. Okay, okay. The phone dropped, is it?
I have to run. Yeah.
Last question, okay.
Yes.
I'll not be shameless
No, I
by
have to
extending my
run
time in
because-
10 more minutes.
Okay, go ahead, yes.
What's keeping Ridham Desai busy these days?
No, please don't. Yeah.
What's keeping Ridham Desai busy these days? Apart from works and stocks and analyzing reports.
I am actually, Nikunj, I'm completely free. I don't have much keeping me busy. I have
So
a
then
lot
I should
of time
extend
for
my interview
myself,
with you.
and I think that's how life is evolving.
Control over your time.
Well, we'll have a cup of coffee in your studio and do another one, because right now they are calling me down there and I have to start my summit.
Compulsions. But really appreciate your time. Thank you for joining
Thank
us.
you.
And that
Thank
red
you.
color, I think,
Thank
is
you.
not an alert. That red color is
Thank you.
welcome to India
Thank
for
you.
all the investors.
Red is the Trump nowadays. A red tie.
That red color is a warning to all the bears.
That's a good one. Enjoy the conference. Thank you for joining us. And cup of coffee with some
See you.
cookies next time in our studio.
Thank you.